How to be poor on paper in retirement. All right, I haven't done this video for a while. The poor on paper. Man, I'm telling you. It's great. Just got off the horn of some. I had 2 people in Indiana today. What's up with that? Indianans? Why you like me so much? What did I ever do to you guys? What did I ever do to make you guys like me so much? I don't like the Colts. Don't like the Pacers. Don't like Indiana Hoosiers. Never liked Bobby Knight. Don't like Mike Pence. What else about Indiana? I don't know. But I guess they like me. How could you not? So I got my red shirt on. You guys think it's for IU, don't you? And you're wrong. My new Hawks shirt. Look, Hawks. Atlanta Hawks. Yes, sir. Yes, sir, skis. Anyway, so talk to these guys. We'll call them Shaggy and Daphne. Shaggy and Daphne. All right. They want to be called Fred and Wilma, but I already had a Fred and Wilma the other day. So we'll call these guys Shaggy and Daphne. If you saw the guy, he's shaggy. Kind of looks shaggy. He's got shaggy hair, little beard and stuff, and it's kind of good folk. Once again, the same old story. No debt, drive old vehicles. They don't even. Did they even have a pension? I don't even think they had a pension. No debt, drive old vehicles. They spend about $5,000 a month in retirement. Add another $1,000 a month for healthcare costs. That's $6,000 a month. He's going to take his Social Security at 70. She's going to take hers at 67. So she's on disability, so she already got her PIA. But once he files, she'll get a bump. What happens, just real quick, with Social Security disability is you get your PIA, your primary insurance amount, the amount at 67, your full retirement age. And then once you switch over to your full retirement age at 67, it changes from your disability to your own retirement benefit, if that makes sense. It shouldn't really change, but it does. I mean, there's no difference in payout or anything like that. But at that stage, because she's on her retirement account, she'll get a bump up for spousal benefit because you won't be on disability anymore once you're at your full retirement age. You'll be on your retirement benefit, which is basically the same as what you're getting before, but now you'll be on your FRA. So when he files, Shaggy, when Shaggy files, what's her name, Daphne will get a jump because she'll get half of Shaggy's. Hope that makes sense. We'll do another video on this at some point. But anyway, so she's on disability right now. She's only making $1,000 a month disability. When he files, he'll make $4,300 a month. All right. Now that's with his delayed earnings credits. So if he were to file, so she won't get half of that money. She won't get half that money because he's filing at 70. She'll get half of his PIA, which is roughly $3,600 a month. All right. I don't want to get too deep in that here today, but just remember, the spousal benefit doesn't go to half of the delayed earnings credits at 70. It only goes to half of his PIA. So the question we have to do is, should he file earlier in order to open up the window for her to get her spousal benefit? We just kind of said, nah, don't, just in case. Because when he files at 70, he's going to get like $4,300 a month. And she'll get $1,800 a month. So watch this. Watch freaking Shaggy. Shaggy! I need a hamburger, Scoob! Scoob, I don't know, Scoob! Those ghosts look kind of scary, Scoob! Isn't it funny how Shaggy likes Scooby snacks too? Wait, does Shaggy like Scooby snacks? I think so. Scooby-Dooby-Doo, he loves Scooby snacks. I think Shaggy likes Scooby snacks. And they say, all right, here's a Scooby snack. It's funny how Shaggy was so skinny, and yet he just used to eat like freaking... Why is Shaggy so skinny? I guess all that running he would do with his wheels turn like that. Scooby-Doo. All right, so check this out. So here we are. They got their RMDs right here. This is in their 1040 and 2031, the RMDs, and Social Security, $81,000. All right, so if I don't even have my calculator, I think even your old buddy Josh, can figure out that tax. That's 102,000 schmackaroonies. Of their $81,000 of Social Security, only $21,000 is subject to taxation. So we take their $21,000 RMDs, their $21,000 of taxable Social Security, that's $42,000 as our AGI. We subtract our standard deduction, and then we subtract our personal exemption. Now, as a side note, Right Capital calls this a qualified business income deduction. It's not in 2026. It'll go back to personal exemption. So you'll notice in 2020 right here, I get this question a lot. Why does it say I got QBI? I had one guy email me. He's like, oh, this Right Capital's wrong. I said, no, and that's okay. I just emailed back. So no, this is going to be a personal exemption. So standard deduction will be going down in 2026 once the Trump tax bill goes away, and your personal exemptions will come back. So line 13 what Right Capital is assuming that will be your personal exemption. We don't know exactly what the 1040 will look like at that point. But anyway, so you got 42,000 as AGI minus this, minus that. So that's 29,000 of deductions. So our taxable income is $13,000 bucks. $13,000 bucks on $102,000 of income. They pay $1,300 of taxes on $102,000 of income. So let's draw this out here so you can see. I just want to show you again. We got 8105. I'm just going 81,000, 21,000. Okay, so let's watch what we got here. All right, so be poor on paper. So we got 81,000 of social. I've got 21,000 of IRA. 81,000 of social. So the first thing we're going to do is figure out our taxable Social Security. And we do that by taking half of that. It's going to be what, 40,500. Bring this guy down, 21,000. So that's 61,500. All right, 61,500. That's our provisional income. Because they're married, the first 32,000 is free. 32 to 44 is 12,000. Which half of that is subject to taxation. It's times 0.5. And then 8 says 61,500 minus 44. I don't know what that is. So let me get do I have my calculator? No, I don't. So we're going to do minus 44. I think it's what, 16,500? That will be 0, 5, 1, 17,000. Yeah, 17,000 bucks. Is that right? Oh, 500. Yeah, it'd be 16,500, right? I think so. 16,500. I need my calculator. And that's times 8.5. 16,000. Let me just do it on this thing. There's my calculator over there. Can I reach it? Let's see if I can't reach my calculator. Yes, I can. Sweet. So we got, there we go. So 16, let me just, hold on a second. We're going to pause real quick. It's actually 17,500. Your fault. I almost got one by you, seeing who's paying attention. Penelope, you paying attention out there? Huh? Marie, you paying attention out there? Huh? CB, Prairie Mark, you paying attention? So 17,500 times 0.85, that's $14,875. All right, 14,875 plus 6,000 is $20,875 of their Social Security subject to taxation. 20,875 of their 81,000 Social Security. Let's see what Right Capital's got in here. 21,098. So we're basically almost exactly on. Of course, I didn't use the exact numbers that Right Capital used, but you can see that's their taxable Social Security. What's your old buddy Josh's taxable Social Security? 20,875. So 25% of their social is subject to taxation. That means 75% of their social is not subject to taxation. All right. So now we take our taxable Social Security. I'm just 20,875. We add their $21,000 of IRA distributions. That's 41,875. We subtract by their standard deduction and we got 29,000 of standard deductions and personal exemptions. 29,000. So so this is AGI. That's their deductions. Their taxable income is about 12,000. 11,875, something like that, times 0.10. They're in 10% tax bracket. And so, again, you can see that right there. And that's, look, man, but yet how much money they got? $102,000? 102? What's their taxes? 10% of that? $1,200? Dude, you kidding me? So $1,200 divided by 102,000. That's a 1.2% effective tax rate. 1.2%. That's how you get poor on paper. You maximize your social, and even here, they still got RMDs of $21,000. Isn't that crazy? Now watch what happens. All right, let me pause it real quick. So here we're going to go out to 2041. Notice their Social Security has gone up by $20,000, but their taxable Social Security has gone up by $22,000. Why would that be? Because the tax law that Reagan signed, that the Democrats and the Senate and the House passed, that Reagan signed, did not inflate the taxation on Social Security. It's such a freaking scam, dude. It really pisses me off, pardon my French. You see that? 102 is their Social Security. Before it was 81. Before, 21,000 of their Social Security is taxable. Now 102 and 43,000. Well, they got a little bit more RMDs. Yes, that is true. But now you can see right now, they had RMDs before at 21,000, now they got $33,000 of RMDs. All right, so now we got 102 plus 33. So now we got $135,000 of income. Here we had $132,000 of income. So we got $33,000 of income, but so $33,000 of total spending power. Their AGI is 80,000. Before their AGI was 41,000. So they increased their income by 30,000, but they doubled their AGI. They increased their AGI by 100,000. That's a tax torpedo right there. It's such a scam. That really ticks me off. So they increased their income by $30,000, but they increased their AGI by 100%. Crazy, man. All right, so now on top of that, we go down here and we see their taxable income, $41,000. All right, remember, they increased their income by $33,000. Their taxable income increased from $12,000 to a freaking $41,000. That's almost 3.5 times. That's the tax torpedo. Perfect example of the tax torpedo right there. And the only thing you can do about it is to make sure that you reduce your RMDs. That's the only thing you can do. Reduce your RMDs and you're going to be fine. And how do you they're still going to be poor on paper. I mean, watch this, man. Look at this. They're still only paying $4,200 in taxes on $145,000 of income. But still, that's the issue of the tax torpedo. Yeah, it's still frustrating me. So they increased their income by $33,000, right, which is, let's say 35% increase in their income. But they increased their taxes by, their taxes here are $1,200, now they're $4,200. They increased their taxes by 400%. So a 33% increase in income, 400% increase in taxes. I mean, it's still low. No one's going to cry over spilt milk. It's just still, that's the nature of the tax code. That's how alternative minimum tax used to be. That's how the initial IRMA stuff used to be too. Yeah, it was IRMA. And that's also how net investment income, NIIT is, net investment income tax as well, is that it's not adjusted for inflation. All right, it's not. And so what happens is we're stuck at $200,000 for single taxpayers and $250,000 for married taxpayers. It's been like that since they incorporated NIIT, the 3.8% extra tax. So, it seems like, well, I'm never going to have to pay that. That's what people thought about Social Security. I'll never have to pay Social Security tax. Anyway, be poor on paper. Maximize your Social Security, minimize your IRAs, minimize your other income as well. That's the way to do it. And the guy I was just talking to earlier today from Indiana, same kind of thing. So he's going to be on Obamacare. He's retiring at 60. He's going to, start taking Medicare at 65. So he's going to be on Obamacare from 60 to 65. And we're like, well, you're going to get these massive subsidies if you keep your income low enough, like $18,000 a year. So he's going to start pulling money out of his Roth. And I said, normally I don't recommend that, but Obamacare premium credits are freaking huge, dude, because he's going to be poor on paper. All right. Love your thoughts. God bless.